one of the things that I've always noticed and I always call out to people is it's not always about the trends going in the same direction. It could be that 24 months view of the world might be quite rosy versus 3 to 5 year outlook might be quite stringent or, might be quite contractive, right? The heat of the market. How does this help people because it's more about where the market is heading. It's not so much about where the market is right now. And so how do people infer from this as to where the market is heading? I think, every election is never about property, but there is always something about property, be it the negative gearing or the supporting the first-time buyers. I think there is also big impacts on renewables, and they've been talking a lot about renewables in these elections as well. I strongly believe when you talk about the fundamentals of property investing, owner-occupiers are the ones that provides the stabilities to the market, and they are the one that drive what I call it is the real growth in the market. The number of periods of the long-term hold of the properties in some of these locations as well. And if you're treating property as a commodity and going to trade it as a stock, then you can't just trust a buyer's agent to make these decisions for you. Co-living properties can generate almost $140,000 in passive income and net of $40,000 in passive income after mortgage repayments, and they sit in an average yield of about 10%. Hello and welcome to another episode of Help Me Buy Property podcast. Today we are talking about the current market update, the prediction secrets for the month, and same as usual, we have our resident data, the property guru, Mr. John Lindeman here, will be co-hosting with me today. Now, for people who have been sitting on the fence line for quite some time and, they've been waiting for the market to turn around, I think this is the time. And so watch till the very end where John goes around talking about the predicting market secrets. And we're not talking about, what are the next hotspots, because everyone talks about hotspots. We are going to talk about how to identify these hotspots. So stay tuned till the very end and get the golden nuggets. Let's give a warm welcome to John. John, how are you today?
I'm very well. Thank you, Moss.
So, there's a lot that is happening out in the market right now in 2025, especially where we are in the world or in the current macro environment. So let's kick it off, with, the hottest place to look out for in 2025, and I'll hand it over to you.
Thank you very much. This is just to summarize what you said, Moss, the housing market update, forecasts, and my prediction secrets. And one of the things I'm going to cover is a suburb hot or not? How do you tell? It's a very quick and easy and free way of doing this within a matter of seconds. So I'll share that with you as well. So let's look at the national housing market, Moss. And here I use CoreLogic data. So it's not my data. It's actually used by CoreLogic. And this tells you the median value of all our capital cities as at the end of March. And you can see Sydney is still the dearest city in which to buy. Brisbane is second dearest, then followed by Canberra, and then Adelaide, Perth, and poor old Melbourne's in sixth spot, and it's only followed by Hobart and Darwin. So Melbourne is in a very unusual situation. Will that continue? Will it improve? We'll find out when we look at my forecasts. When we look at the annual change, you can see the three big performers there, Brisbane, Adelaide and Perth, have all experienced strong price growth over the last year. But when we look at the last quarter, you'll notice a significant change in that Melbourne has now turned positive and Darwin also strongly positive with over 2.5% growth just in the last 3 months. And then we look at the last month, and now you can see that Melbourne the last month was the third best performing capital city in the whole of Australia. So there's definitely a big turnaround there. Let's look then ahead to see, well, what's likely to happen. And here I use my own database to produce capital city and state forecasts. It's the only database, predictive database in Australia that has a innovation patent. And what it does is it collects data for all 15,000 suburbs and towns around Australia, all types of residential property. It gives me a snapshot of past performance and the current type of market, but more importantly, it gives me the rental yield and cash flow potential, imminent price growth, and long-term price movement outlook. So we can predict up to 5 years into the future for any suburb. How does it work? Well, it looks at houses or units in all 15,000 suburbs and towns, and it reads the current type of market. So how do I look at that? I look at 5 different types of markets. There's ones where the suburbs where there's strong growth occurring. What that means is that prices are going up by more than 10% per annum. Or there could be heavy falls, which means prices are falling by more than 10%. And somewhere in between, you've got balanced markets where there's no change, or moderate growth, less than 10% or less, and moderate falls, 10% or less. Imminent change potential, we do exactly the same thing. So we look at every suburb in terms of its growth potential using the same 5 types of measurements. And the forecast long-term change potential, the same again. So when we look at any market, and we can do this for a capital city and look at all of the suburbs in a capital city, we can see how all of those suburbs are moving which way. So to show you with a typical city what's that looks like, let's say this is not a real city, but it's a hypothetical one, thank goodness, because you can see this huge black wedge, and that means that nearly half of the suburbs in that city would be experiencing heavy falls, that is, falls of more than 10%, and very few with any growth at all. There's a tiny little red wedge, and you can tell by the size of the wedge how many suburbs we're looking at. When we look ahead 3 years, you can see how that's changed again, and now nearly half of the suburbs in that city would be experiencing strong growth over 3 years from now. So you can see how important it is to look at the individual suburbs rather than just the overall view of the city.
And it's important to also, just stopping you there, John,
yes,
when you're looking at some of these trends, when you talk about right now versus 1 year versus 3 years, one of the things that I've always noticed and I always call out to people is it's not always about the trends going in the same direction. It could be that 24 months view of the world might be quite rosy versus 3 to 5 year outlook might be quite stringent or, might be quite contractive, right? So it's important to, look at, what 3 years is doing versus what 1 year is doing as well, because you might see some imminent short-term growth, but then the overall outlook might not look that great. And we'll talk a bit about Darwin as well, because I see Darwin popping up quite aggressively. And so we'll talk about that, on some of the next slides.
Yes, of course. So when I look at Sydney, and again, as you said, Moss, it's important to look at what that red wedge, which suburbs they are. And right now, all of the growth is concentrated in the low-priced end of the market. It's first-time buyers that are doing all of the buying, and that's where the growth is. When we look ahead, you can see that nearly half of Sydney's suburbs will be in growth, mostly moderate growth, but that red wedge is getting bigger. And then 3 years from now, again, you can see even over half of Sydney's suburbs will be in moderate to strong growth. And that growth will start to move into the middle part of the market. At the moment, it's all first-time buyers, but it's starting to, and will be moving into the upgrader markets as well. So the overall growth will be improving in Sydney, probably moderate growth overall, but quite a few suburbs with strong growth potential. Look at Melbourne, and there's no red there at all. So no suburbs with strong growth right now. But what about the future? And look at this, a year from now, our database is saying that Melbourne will actually have over half of its suburbs in growth and quite a few in strong growth. But again, they will be suburbs at the bottom end of the market, very much first-home buyer areas like Melton, Pakenham, Cranbourne, those sorts of markets. and also around the Bayside, the cheaper areas around Carrum Downs, around those sorts of areas will be experiencing strong growth. And that's going to increase dramatically over the next 3 years. So we're predicting pretty good growth for Melbourne overall and strong growth for nearly a third of Melbourne's suburbs. So it's from being the sixth dearest suburb, it's likely to improve dramatically over the next few years. And again, that growth will move into the middle parts of the market over that period of time. Brisbane right now, very strong market with nearly a quarter of the suburbs in strong growth. But differently to Sydney and Melbourne, these suburbs are all at the top end of the market. So the growth which started years ago has now moved up. It's rippled through into the upgrader and the well-established family suburban areas. And it's likely to continue like that. So the growth will continue. Overall, Brisbane's looking pretty good for growth. And even when we look 3 years ahead, you can see there's no black there at all. And virtually, nearly well over 3/4 of Brisbane's suburbs will be in growth, or not 3/4, well over half will be in growth, and over a quarter will be in strong growth. But that growth, as I said, is likely to be mainly in the upper areas of the market, the dearer suburbs. Adelaide right now is really booming. It's and it is the next to Brisbane, it's the next most expensive city in which to buy. And you can see no black again, a very strong 1/3 of all suburbs in strong growth. That's going to pull back a bit because obviously that growth can't continue. It's already in the higher price suburbs. And so you can see that some grey and black suburbs emerging with falls, but not that many. And overall, Brisbane will still be in moderate to strong growth a year from now. It'll pull back a bit more, but again, it's not any cause for concern as long as you avoid those areas where heavy falls are likely. And that's more likely to be the areas where the strong growth occurred first. So the lower priced areas could experience some downturn, but overall pretty good outlook for the Adelaide property market.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages, or off-the-plan properties or apartments. Get yourself copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book. It's easy to read. It has a lot of stories. It has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. And so is it true to, make an inference here that, areas which have already seen significant amount of growth, when you talk about Adelaide, you talk about lower socioeconomic areas or lower price point areas of Elizabeth, Paraloe, Morfett, Christie, all of these areas where it grew quite significantly over the last sort of 3 to 4 years are the areas where the market is going to saturate and hold still in flat, while the higher and the bigger price points, see much higher growth?
Yes, that's exactly right, Moss. That's what's occurring right now. And you can see that in Perth, exactly the same trend where Perth right now, there's no suburbs with heavy falls. But when we look ahead a year from now, you can see that there will be some heavy falls in those lower price suburbs that experienced all the growth. But, if prices have doubled or more than doubled in 3 years, it's to be expected they'll come back a bit. But we're not expecting any sort of market crash or anything like that. If you look at that pie chart, you can see that the number of suburbs in growth is balanced by the number that won't be in growth. So it'll probably be in balance, but 3 years from now, it's going to improve once again. So a slight correction for Perth, But and that growth, which is pretty much all at the top end of the market, is now moving as people downsize and they move into these sort of coastal retiree touristy areas. That's where all the growth is likely to occur. Now, I'm going to share with you my secret prediction methodologies, and there are 3 that I'd like to do. Now, we've only got time to do one each month. So the first one, of course, is the heat. How can you tell how hot a market is? So when we look at research, and I think you might find this interesting, Moss, because I know you believe strongly in research, as I do, yet it's a fact that 80% of people rely on intuition, gut feel, and instinct, and only 20% rely on research. But research can be easy and it can be interesting. And so I'll just share with you my techniques on how you can assess the heat of a market.
When it comes to reasoning and research, it's never always about testing it out yourself and taking the heat and, taking the fall, right?
Yeah.
There are ways to, come back to conducive research in a way which is, not harming to yourself or harming your portfolio, right? It's just...
Yeah. Anyway, so looking at heat, the way we do this, and this is any suburb, we compare the apparent to the actual listings. And I'll explain what I mean by that. And if half or more of the listings are under offer, under contract, that means they're not actual listings. That's a hot market. If they're over 10% but less than half under offer, under contract, that's a warm market. At less than 10% under offer, under contract, that's a cold market. And because I've studied the market for so long, I've been able to work out these percentages and how accurate they are and what they tell you. So it's very easy to use, but it's very, very reliable. To get,
If you go back to the previous slide, when you talk about where the heat of the market is, how does this help people to, because it's more about where the market is heading. It's not so much about where the market is right now. And so how do people infer from this as to where the market is heading? Is that like a percentage increase of, under contract or under offer that gives people a reasonable comfortableness that, okay, it's going to turn from a cold market to a warm market or a warm market to a hot market?
It could do. This is more about assessing what the current market is, what its performance is and whether you've got to go in quickly or whether you've got lots of time. The price growth potential, which is the next, I'll share that next time, actually tells you how to make, the prediction in terms of which way it's moving. But this will tell you whether or not, let's say if you've got a property, is it time to sell? You think it might be. This will tell you whether or not it's the right time to sell or whether you can wait. So shall I?
Yeah. Let's go to the next slide. Yes.
Okay, right.
Where do people find this data?
Okay, very easy. You can get the number of apparent listings and actual listings from realestate.com.au. And you simply go to properties to buy, choose a suburb, don't include surrounding suburbs. You choose houses, townhouses, or apartments and units. And then you look at the number of apparent listings, exclude those under offer, under contract to get the number of actual listings. So I'll show you how this works. Let's look at Nambour, which is up in Queensland, the Sunshine Coast. So we go to Nambour under properties to call home, and then we make sure we don't include surrounding areas. We then go to the filters and we pick either house and townhouse, always put those together, or apartment and unit. That's pretty much all you have to do. Click on search to get the number. And there it is, 68 properties listed for sale in Nambour. Now we go back to the filters and we click on exclude properties under contract, under offer, and see what number comes up. And it dropped to 59. So using that template I've given you here, so it's over 10%, but less than half. And that means it's a warm market. So that's not telling you whether it's the right time to sell or buy. It's saying it's not moving that quickly that you have to be concerned. In other words, if you're thinking of selling and the other indicators tell you it's a good time to sell, you can take your time. But if it's moving the other way, again, you don't really have to worry either way. Let's look at another one, Launceston. Let's say somebody has suggested to you that Launceston is about to boom, and this is a market you should be buying in really quickly, because if you don't, they'll go like hotcakes and you'll miss out. you do the same thing. Don't include surrounding areas. Click on houses and townhouses or apartments and units and go to search. And it says there are 34 properties available on the market. Now we go back to that filter to exclude properties under contract under offer and see how it changes. Can you see what happened, Moss?
Yeah. Wow.
It dropped by 1.
Yeah. Not much.
So that means that is a really cold market.
Yeah.
It probably means there's really no growth potential whatsoever, but it's also telling you if you wanted to wait, yes, you may as well wait because nothing much is happening and nor is it going to happen for quite a long time. So you've got time on your side, and if you're going to sell now would not be a good time to sell in Launceston. So either way, waiting is the best option.
Yeah.
And we go to Durack, which is in the Northern Territory, and it's in Darwin, Palmerston. So let's go again, include surrounding areas. No, don't include them. Click on houses, townhouses, and I've got 16 properties listed for sale in Durack. We go to the filter and we exclude those under contract under offer. And what have I got? 4. That is more than 50%, isn't it?
Yeah. Wow.
It's a lot more. And it's over there. It's a hot market, really, really hot, because drop from 16 to 4 is, well, more than half. And that means, and generally when we've looked at, and I've done this over many, many suburbs using our database, we check all this, and it's pretty much as you wanted to talk about the top end, that's the market at the moment. Now, the prices in Darwin, Palmerston have only gone up 4% in the last years. So, but that you saw the growth in the last 3 months is really accelerating.
Yeah.
And so it's obvious that something's happening in Darwin.
Yeah. And it's quite interesting. I've never been a big believer of Darwin and the market for Darwin because, the single economic dependency where the market sits, in relation to Northern Territory, right? So I know a lot of buyers agents are out there buying a lot of properties because they're chasing yields, and Darwin has always offered, amazing yields. And of course, the price point is quite significantly lower. But when you look at other conditions, because data tells you one story, you need to always validate the data with the story that sits behind the data, right? My personal feeling or my personal research has always been that there is not enough infrastructure, enough population growth, enough story behind the data to give me the confidence that, hey, I need to go out there and invest. So a lot of this is what I call it is, sentiment-based investing or buyers agents driven, demand that is coming through. And, you can see that the numbers are not massive. You're not looking at 100, 200 listings. You're talking about 14, 15 listings, 20 listings, dropping down to 4. And so, of course, on a percentage basis, it shows big changes. But when you talk about the numbers, they're not big numbers, right? I have a client who sat in, NT for quite some time chasing growth, and they've seen the ups and the downs, quite frequently. So, I'm always wary of non-fundamental investing, and I would always cautious people of, hey, short-term growth is great, provided that, you follow the market quite religiously and come out when the time is right. But, when I look at the long-term outlook, what do you feel? Does Darwin and NT offers the same long-term outlook like what Melbourne has to offer or Brisbane and Sydney has to offer?
I think the fundamental difference is with Darwin Palmerston is that it is buyers agents and investors who are doing all the buying because they're attracted. You can buy in the cheaper suburbs in Darwin, those buy prices around $450, $550.
Yeah.
There's been no price growth there for over 10 years. So even though prices went up, they came back down. We're now back to where we were 10 years ago.
Yeah.
And Darwin is the cheapest capital city in which to buy property. Yields are well over 6%. So there's the attraction for investors. They're the ones who are doing all the buying. Different to Melbourne, where it's not investors, but it's first-time buyers. Owner-occupiers are doing all the buying because the yields are too low to really attract investors yet.
Yeah.
The fundamental difference then, Moss, is that Melbourne has got much greater stability because first-time buyers are not going to be in and out, sort of buying in a slice.
Yeah.
Whereas in Darwin, investors, if things go bad, they'll just simply put the properties on the market and get out.
Definitely.
Yeah.
And I strongly believe when you talk about the fundamentals of property investing, owner-occupiers are the ones that provides the stabilities to the market, and they are the one that, drive what I call it is the real growth in the market, right? Investors is what I always tend to refer this as nominal growth, because, there is a bit of volatility attached to it. And so you need to always look at the number of periods of the long-term hold of, the properties in some of these locations as well. And if you're treating property as a commodity and going to trade it as a stock, then you can't just trust a buyer's agent to make these decisions for you. You need to be out there, what I call it is live trading these properties, and being on the cusp of buying and selling in like span of 6 to 12 months, right? So that's the level of trading that you need to look at. I mean, the opportunity is there, for people who are astute and who wants to come in and out very quickly, or the reno flips, right? So you buy really, really poor property, renovate it, and some buyer's agent would pick it up because it generates great amount of yield for another investor who's purely looking from a cash yield perspective. I think one thing that I call out loud all the time, which is just very, very sad in a way as well, is cash flow is good, cash flow is great, but it's not going to get you out of the rat race. You talk about wealth creation and rat race, it's the growth that is going to get you out of the rat race, right? And so be careful as to how much over dependence there is on cash flow versus growth. I'm not saying cash flow is not important, but growth far supersedes, the cash flow that comes through, right? So
that's right. And the other thing about the Northern Territory and Darwin and Palmerston in particular is that it has a far greater percentage of people moving interstate. So in and out, there's a lot more movement in the Northern Territory of people moving in and out of that the territory than there is in any other territory or state. And and the percentage of renters is much higher as well. So what that means is, again, it adds to that volatility and instability. People decide to leave for whatever reason, and then the rent demand collapses. Suddenly, of course, the yield will go down. So yeah, very, very volatile.
And I've heard people say this out. I was hearing to one of the podcasts where people were calling NT as the next Perth. How do you feel about that?
No, I don't agree with that at all. I think when you look at the numbers, you can see a number of issues. And as I said, the listings are very low. They have dropped a lot and sales have increased a lot. But median time on market in all of these suburbs is still well over 60 days.
Yes.
That's not good. You need to have that reduction in medium time on market to show that, and this is what I'll be explaining in the next month. If median time on market is reducing, that indicates more buyer demand and genuine buyer demand as well. But this is all just investors, speculators, and it's very, very dangerous. I think when you look back in the history of Darwin in particular, there was one period back in 2008 where it was the most expensive city in which to buy property. That was after the GFC.
Yeah.
And, but since then it's just gone backwards. Obviously it's going to recover, but I think Melbourne is by far and away the more stable city, for reasons that more first-time buyers will be buying. And I know you wanted to talk about the upcoming election and the housing.
I think that's a good segue. It's a good segue because everyone is talking about the election and the federal elections and Dutton versus Labour. Basically that's what the story is. So let's talk a bit about what sort of trends do you see in an election year when you talk about property and the impacts of property versus elections.
Normally you don't really have any impact at all because all the recent elections haven't been fought on housing as the main subject, but this one is different. It started off about being responsible growth and the cost of living crisis, and it's morphed into this discussion about the housing market. And when you look at the policies, you look at Labor's 5% deposit scheme, that is predicated on price growth occurring, because if they put up 15% of the property price, which is the government's component of the deposit, they'll want to get their money back, and they'll only do so if property prices increase. And no matter which side you're sort of interested in or want to back, both of them are going to increase the demand for properties, and that means that property prices will go up as a result of this election. So it's one of the few times where we've seen an actual election that's going to have some impact on the property market.
Yeah. And it's always interesting. I think, every election is never about property, but there is always something about property, be it the negative gearing or the supporting the first-time buyers. I think there is also big impacts on renewables, and they've been talking a lot about renewables in these elections as well. I saw the current Prime Minister talking a bit about that as well. But My view of the world when it comes to renewables is there is big impacts on investors because the changes that you're talking about minimum rental standards, the changes in relation to, making your house convert from gas to electricity, for example, it's not just owner-occupier. So, there would be flood of rebates that would be coming through in pretty much every state. I think Victoria is taking the lead, but you would see New South Wales, Adelaide, Perth following the trend. And so keep your ears and eyes close to it. And so if you have an aircon upgrade or, there is some sort of renovations that you're planning to do, just wait and watch and see what some of these news comes out about, because you would see that there is a lot of free money being thrown to some of these energy rebates or renewable energy rebates. And, you could save some cost there.
That's very astute. Also, I think it very, very wise. Wait and see, because things will happen, definitely.
Definitely. Any final words, John? Let's bring this up together for people.
Okay. Well, I've talked a little bit about heat. I'd like to next month talk about how you can measure price growth potential. That is actually looking forward and predicting what's likely, and also looking at the risk side. How do you estimate risk? And it's, again, very easy to do. So I'll cover those in coming episodes.
Thank you very much. And for viewers and listeners, if you have any questions, comments about today's episodes, or if you feel differently about NT or any of the insights that we were talking about today, feel free to jump in either on our socials or leave a comment here or ping me or John and, let's have a chat. We can always bring you on the podcast if you have different view of the world. Thank you for listening to us. Take care, stay safe, keep smiling, keep investing. This is John and Moss checking out. Adios.
Till next time. Bye.